Welcome back. You're watching The Firm. Now they say, well begun is half done. But who's going to finish the other half? That's the question plaguing many of India's financial regulations. So today we're going to talk about laws that fall just that short of operationalization, either because of incomplete rules or because of lack of coordination between regulators. Now take differential voting right shares, for instance, an issue we have covered extensively on this show. While DVR shares were allowed starting 2001, there still is no defined clarity on how to price them. Natasha Parekh and Paridhi Shroff have many more such examples.
In 2004, the central government introduced guidelines for Indian depository receipts. An IDR is a negotiable bank-issued certificate representing ownership of stock securities by an investor outside India. It's the Indian version of an ADR, and foreign companies can list in India via IDRs. The Companies Act, DIPP guidelines and listing agreements have all been amended to facilitate IDRs. Yet, 3 years on and not one IDR has been issued.
Clearly for any listing or in any listing, you've got compliances under the Companies Act, but it is the securities law and the securities regulator that then governs the actual listing process and trading of instruments. So clearly I think the need of the hour is for SEBI to actually come out with something under either the DIPP guidelines or as a separate regulatory mechanism which provides for how the IDR needs to be floated, what are the filings that one would need to make with the SEBI.
The second set of issues that arise flow from a mismatch of the governance and the disclosure regimes that apply to a foreign issuer making a transaction in an Indian market. By way of example, reporting requirements under the listing agreements. Some markets have either a half-yearly or an annual reporting system. We have a quarterly reporting system. Now that obviously has very significant practical implications on issuers.
Another non-starter is FCEBs or foreign currency exchangeable bonds. An FCEB is an instrument that helps Indian promoters raise money abroad by issuing foreign currency bonds against the value of their investments in shares of their listed group companies. A nice way for, say, holding companies to unlock the value of their holdings in group companies. Now, it's been a year since SEBI issued FCEB guidelines, but no FCEBs have been issued yet. No surprise, as RBI has yet to complete the rulemaking. For instance, in matters of pricing of shares upon exchange into bonds and how and where the shares are held until redemption.
Yes, I mean there is some regulatory discomfort on the FCEB issuances for pricing. The conservative view over there is that the pricing will be similar to what is there in FCCBs. So you have a base value which is the typical SEBI price, 26-week, 2-week high lows, and that's going to be a problem because since these instruments are locked in, the shares actually which the promoters put in are locked in for the entire period. Promoters may not always find it attractive to comply with the pricing requirements. The SEBI seems to take one view, but the RBI is not willing to bow down on the foreign exchange regulations. So we would ideally like some kind of harmony between the SEBI and the RBI where it's seamless. They tried to introduce the single window clearance, that's not worked. If we have a little more coordination between the SEBI and the RBI, I think things will get much easier for deals to happen.
Now this one shook the market. On October 25, 2007, SEBI announced restrictions on the issuance of participatory notes and the registration of offshore derivative funds. The reason? To control foreign currency inflows and enhance transparency in the marketplace. At that time, SEBI said only regulated entities can register as FIIs or foreign institutional investors. 6 months on and there's no clarity yet on what constitutes a regulated entity.
What we find with our clients is that sometimes there's not enough clarity in terms of regulated and registered entity and how to treat them and widely held FII. I mean, in terms of the number of investors in the FII, is it more than, is it widely held in terms of number of investors as well as any particular holding by the largest investors? So there is a lot of confusion on that front.
The list of unresolved issues also includes redeemable preference shares. They've gone from being classified as equity capital to debt, and now have to conform to RBI's external commercial borrowings or ECB guidelines, making the issue of redeemable preference shares to foreign investors tough.
Artificially, what was a form of capital was treated as a form of debt. And then you have the problem of when you essentially describe a dog as a cat, then it raises all sorts of issues. For instance, whether dividends, which are essentially distributions of profit, should be treated as interest. Preference shares which were issued to local investors stood as part of the capital, but when the holder was a foreign one, they became effectively a debt instrument. Restrictions on the form of how coupon could be paid. If it was a debt instrument, why could you not create security?
That's at least half a dozen financial instruments or laws that simply cannot be operationalized. The list is longer, but we'll keep that for another day. In Mumbai with Natasha Parekh and Paridhi Shroff, Ramya Ramurthy.
All right, now it's time for all the news on Bulletin Board.
The ICAI is clamping down even further on accounting norms. The Council of the ICAI recently issued Accounting Standard 32 or AS32, which mandates that companies make disclosures in a manner such that risk to the company on account of financial instruments is easily accessible. Which means that companies must disclose not just quantitative information on financial instruments, but qualitative information on how risk will vary given changes in forex rates, interest rates, etc. AS32 will be recommended for all companies in 2009 and mandatory 2011 onwards. The Supreme Court's now forcing the Board of Revenue and the tax departments to cooperate. In the case of a rubber company in Kerala, the sales tax authorities of the state appealed to retrospectively withdraw tax exemptions claimed by the assessee from 1997 to 1999. This after the Revenue Board had granted these tax exemptions via a circular. The Supreme Court has finally ruled that administrative relief granted by the board within its jurisdiction cannot be withdrawn. A ruling that brings relief to taxpayers, especially after similar conflicts among revenue and tax authorities have surfaced at least twice in the recent past.
Well, that brings us to the end of this edition of The Firm. We'll be back the week after next. Till then, you can reach us on The Firm at network18online.com. Thanks for watching.